Sometimes forex trading is a wild and woolly place to be. That's why Hugh's here, to pose your questions to Walter, the naked forex guy. Hugh's got questions, and Walter's got the answers. Here at the Truth About FX podcast.
Hey, Walter, what is leverage, and how do I know if I'm using too much?
What a great question. So, all right. So this is essentially how it works. Forex trading is really different to, say, trading stocks because it's highly leveraged. And the reason why it's highly leveraged is that the market only moves a fraction of a cent, or maybe at the most a cent or two every day. So obviously, when you're talking about stocks move a lot faster than that. So you can buy stocks with leverage, which is what they call like margin trading, where maybe like if you put up $50,000, your broker might allow you to trade $100,000 worth of stock. So they might double your account size. You have to pay interest on that loan and all that, but that's sort of margin trading in the stock world. Now, in Forex, it's a little bit different because the small movements mean that if you're really going to make any money at this, you need to have huge leverage. So most of your brokers are going to be giving you 50. What is it in the States now? Is it 50 to 1? Is that
yeah,
what the
50 to 1 max.
Okay, 50 to 1 max in the States. In other countries, you can get as much as 400 to 1 or 500 to 1 probably. I've seen 400 to 1. I've heard of 500 to 1. But people say that leverage is a bad thing because they say you're going to blow up your account if you have high leverage. It's not really the leverage that gets you. I mean, the way I look at leverage is it's like fire. Fire can be used to cook your food, so it can do something good. It can be used to boil some water and kill the baddies and some bacteria or whatever in the water. But it also can burn your house down, and that's really what leverage is like. It's one of those things where if you know how to use it, and you're risk averse, and you're not going gangbusters and trying to really make as much as you can, then you'll probably survive. So what happens where people get into trouble is they just they ratchet up the trade as high as they can, and even if they do well for a while and start making money and start doubling their account, occasionally they'll run into some losers and that'll knock them back down, and then psychologically they're in big trouble because they've lost so much of their account. So even if they didn't blow up their account, they're at a place psychologically where it's difficult to continue. So leverage is basically where you have, say, $1,000 and your broker allows you to trade $50,000 worth of currency. So if you have a U.S. broker and you have $1,000, let's say you have $3,000 in your account, okay, and you're going to trade, you're going to set aside $1,000 for a particular trade. Well, that broker will leverage that $1,000 for you and say, okay, you've got $1,000. I'm going to allow you to trade $50,000 worth of the euro or $50,000 worth of the Aussie dollar or whatever. And what that means is you can make huge gains because you're so leveraged, but obviously it works both ways. You can also incur huge losses and knock your account back quite a bit if you're not careful. So that's really what leverage is. It's just a loan from your broker, and your broker is allowing you to trade for more money per movement in the Forex market simply because the Forex market doesn't move that much. That's why it's such a highly leveraged instrument.
Okay. Well, thanks for that. I'm sure that'll help a lot of people.
Great.